Hello, everyone. My name is Amy Holland, Marketing Manager at KBC Advanced Technologies. On behalf of KBC, I would like to thank you for joining our first Insights on Energy webinar discussing regional pivot points. We plan to bring you a series of webinars we hope you find insightful, covering different topics. A few things before we get started. This webinar is being recorded, so for that reason, you will all be muted. You may submit questions through the chat window on the right side of your screen at any point, and they will either be answered during the webinar or at the end. Also, we will be asking questions during the webinar using the polling window by the chat window. Our speaker today is Karl Bartholomew, Principal Consultant and the Regional Practice Coordinator for Strategic Consulting for KBC. Formerly President and Managing Director of Pace Consultants, Inc., now Jacobs Consultancy, Inc., Karl is a widely recognized expert in the economics of technical planning, management, and valuation of refining, petrochemicals, raw materials, and natural gas operations. Now to Karl.
Thank you, Amy. Our topic today is regional pivot points in global refining. First, I'd like to thank my co-author in this venture, who's Mark Rout. He is in our KBC Energy Economics group that provides a lot of our forecast, supply-demand balances, and forward look at the markets. Over the past couple of years, we've issued a number of position documents, what we call our global energy perspectives, and we've looked at the refining industry, we've looked at petrochemicals, gas, unconventional crude oil, shale, at a high level. So today's presentation is going to focus on our observations and opinion of what's been happening in the global refining sector, specifically looking at the supply export centers, what we call our pivot points, and how they've changed over time. Our agenda is going to first cover what I view as the old world order. Let's go back in time to the mid-2000s and see what's happened to refining from that period going forward. And then we're going to take a look at the new dynamics. What's causing the changes that we are seeing? So we'll take a deeper look at that. And then we'll get into what I call our new world order. In other words, where things are shifting on the supply side. And then I'll wrap up with some regional observations looking at each major supply and demand area. If we look at our map here, first let me just make a disclaimer. Mark reminds me to always say that the size of the arrows are not indicative of volume flows. They're just showing product flows in general. If we look at what we consider the old world order, really our main refining center was European-centric. You know, if we look at kind of from the west to east on the map, you had the U.S. moving some products into Latin America, into Europe, but a lot of material coming out of Europe into the New York Harbor, northeast U.S., into Africa, some into Latin America. And then you had the opportunistic flows back and forth between the U.S. West Coast and the Asian market. Now let me cover a couple of the major products movements that show why we are saying that we're seeing changes in our pivots. This chart looks at diesel and gas oil exports from a region to another one. So let me walk through the chart here. If we look at the bottom left, you'll see that this is movements from Asia to other regions over the last 6-year period. And if you look, Asia really peaked in its exports to Europe back in 2009, right about the time of the economic collapse, and has been fairly flat since then. And Latin America had a little peak, but it's been fairly flat, and of course North America has been down. And part of the reason is Asia's essentially retaining its distillate production to meet the local demand. Europe has seen flat to declining movements if you look at the Latin America and specifically the North America movements. But we're seeing a nice pickup of movements now swinging up to Africa and some to the Middle East. Africa is because the European refiners are able to cherry pick and send lower quality diesel into the African markets. And right now the Middle East demand has picked up, so it's showing a bump there. But I'll give the warning ahead of time, we don't expect this movement to the Middle East to last because there's a lot of new refining capacity that's coming on that we'll talk about later, and so we expect to see that movement drop. And then we have the movements coming out of the North American market into primarily Europe and Latin America. And we've all expected that Europe was going to be a big pull from the American market for distillate, but I guess the real surprise has really been the pickup into the Latin American markets. That's really, again, been of some lower quality spec than what Europe or the U.S. market would have, but it's really been helping the U.S. refining industry today. If we go now, when we look at the second major transport fuel that's moved around, looking at gasoline, we see similar dynamics going on. Asia really has only sent minor volumes into the North American market, again, more of an opportunistic fact when we have some type of refining upset. For example, earlier this year when BP's Cherry Point refinery had a major shutdown, we saw movements coming from the Asian market to the West Coast. But it's pretty much a non-factor. We've seen a lot more product moving in Europe over the last several years going into Africa. Again, lower quality, and it's picked up both Latin America. Latin America's been flat to really not much movement at all. But the big drop out of Europe, the big shift has been the great decline in gasoline exports from Europe into the American market. Now that's really due to a number of factors. Besides the economic crisis that lowered the driving in the Americas, you also have the influence of our regulations of the ethanol mandate, which is putting more ethanol and less hydrocarbon product to gasoline, and of course the additional capacity increases in the U.S. We see the same dynamic as we talked about in distillate of increased movements into Latin America. Not as much as the distillate demand, but still a pretty good bump up. So let's drill into what's driving these changes in the pivots for the distillate and gasoline. I always like to start with the fundamentals, and basically what starts everything is looking at the economy and the demographics. What we've had here, the key drivers of our transport demand are really the economic activity. What's happening on new projects, new growth in industry. The other part, though, is the demographics, which is people and the age, the standard of living. What we see in the regions where we've seen a lot of pickup in growth has been Asia and Latin America because those economies are booming, young populations, somewhat affluent. Then if you look at Africa and the Middle East, you've got young and growing populations there also, but not quite as affluent as what we've been seeing in Asia and Latin America. And then we get to the Atlantic Basin, kind of the traditional markets of the U.S. and European, where they're affluent regions, but you've got an aging and declining demographics. So we'll connect this with what happens with oil demand in a couple of more slides. Let me just make a side note. This past year was the first time in 20 years in which the U.S. vehicle miles driven actually declined. So again, that's a reflection of the demographics and general economy. Now, when we go to, we look at how these regions interact with each other, really the last point here about the new pivots changing into different routes really reflects a different view of looking at the world, where we always thought of Atlantic Basin of the Americas to Europe, Europe back to the Americas. Really, we're going to shift the dynamic to looking at the verticals, as we call it. We're going to look at North America, South America, Europe, Africa, and then Asia, Middle East. So let's take a look at what's happening with the economy. These are a couple of 5-year window snapshots looking at the economic growth, what we've expected on kind of the compound average growth for the world and for the major trade regions that we're looking at. And as you might expect, if we go back to the earlier slide on demographics and the economy, the areas that are booming, that are going to have higher than average GDP growth rate, are Asia and South America. If you look, Europe and the U.S. are less than the average growth rate. So, there is a connectivity between the demographics and the economies. Let's take a snapshot then at what's happening with the state of the economies around the world in some of these regions today. If you've kept track of the news, you know that the U.S. economy has been rather sluggish. not bad at 2%, but not great. The Eurozone is practically just barely staying out of recession, where you've got the regions, some countries like Germany and France have some growth, the United Kingdom's flat, but then you've got the real troubled areas in the Eurozone of Portugal, Italy, Greece, and Spain, where they are in recession. In fact, again, if you listen to the news, you'll know Greece is still dominating the whole European economy of whether they will or won't stay in the Eurozone. Now, I'm going to focus for a couple of slides on the U.S. indicators, and then we're going to talk about China indicators. One thing that we look at is what's happening from monetary policy, because the amount of money being lent obviously is critical for people getting financing for new projects and growth. Our U.S. Fed has kept a very cheap dollar in play. This chart shows the effective Fed funds rate, which is the interest rate that the Reserve lends to major banks, other governments. And as you can see from this chart, this is showing an effective. We're taking the impact of inflation out. That really, since the economic crisis, except for a brief period of time, since 2008, we've had pretty much free, if not effectively, zero to negative interest rates effectively for lending. So there's not a whole lot that at least the Federal Reserve on this side of the world can do to improve the economic outlook. There's only so much you can do with monetary policy. A second indicator which proves to be very valuable looking at the American market is what is from the Economics Cycle Research Institute. They provide a weekly leading index. And what this is, it looks at money supply, looks at stocks, it looks at different forecast trends, looks at what's happening with bond spreads, yields, mortgages, a number of factors. And what we've seen is that this has been a relatively good indicator of recessions coming forward. As they like to say, they've called 6 of the last 7 recessions. Of course, my colleague Mark Rout says the pundits say they've called 12 of the last 6 recessions. So the statistics are, take it as you will. The main fact, though, is that when the ECRI index is staying negative or it goes strongly negative, it has been a pretty good indicator that the American market will be in a recession. Right now, the indicator has been in negative territory since late fall. It's still running at about 4 to 4.5% negative. ECRI is saying we probably will see a recession in the U.S. unless that turns up in a short time period. So now let's talk about China, which is a whole different picture. It says something when China is actually showing lower growth in 2009, and people think that's a good thing. Really, the government in China saw where the economy was heating up too fast, too much pull for demand, and so they put the brakes on. So the question really has been, now that they've seems like the economy is growing at the target rate, have they slowed it down too much? There was a recent editorial and column in the Wall Street Journal last week talking about this, where it said that really the impact has been in lending for small and medium businesses, and of course it goes back to what the lending will be for large projects. They're concerned that have they slowed things down too much? And that's going to be a real question. However, again, compared to the other regions, particularly in the Atlantic Basin of the Eurozone and the U.S. market, 7.5% is a pretty good growth rate. So I think, Amy, this is for you.
We have a quick poll question, and let me open up the polls. Something just for fun for about 45 seconds. What is global oil demand? You want to explain a little bit about that? Or?
Well, that's pretty much the question, is how much oil is the world consuming today?
Okay. So you can, if you can get to your polling window, you can probably choose an option.
And I see some people answering, and so far it looks like an even split between no answer to A, B, or C. Okay. Well, the lucky person that said A Wins the prize.
That's right. And we said it was 1 second left to poll, so there we go. I apologize. There we go.
Okay, let's go back. We'll head back now after the poll question and talk about demand rates and oil demand. This reflects back to the economic indicators we talked about earlier. If you look at the areas that we said are booming from a demographic point of view, from a GDP point of view, are the areas where we're seeing the biggest growth demand, China and South America. And again, the economies that are declining in demographics and growth, the U.S. and the Eurozone market, are showing no, if not negative, growth demand going forward for oil. And you can take a look at an interesting comparisons. Let's take South America versus Europe. On previous slide, we looked at the two GDP rates where we saw the delta between Europe and Latin America was about 3%. Here, if you look at South America versus Europe on the growth rate on oil, it's about 4%, which again just confirms that it's a combination of the economy and the demographics that's driving future oil demand. So let's talk next about refining capacity. We just released our KBC Energy Economics, our annual world refining outlook this past month. And what you have is a lot of changes in rationalization of existing refining operations, plus a lot of changes with additions of new refining going forward. In both the European and U.S. markets, a lot of rationalization where less efficient refineries are being shut down. Either they're being put for sale or they're being turned into terminals. For example, in the U.S. Atlantic Basin side, you've had the Yorktown refinery shut down. You had the ConocoPhillips Trainer refinery shut down. Of course, it's being sold. You had Sunoco shut down Eagle Point and Marcus Hook. You've even had shutdowns to some extent on the West Coast with the Bakersfield refinery. And really what's driving that is not just the efficiency of the operation, but it also gets back to the flexibility of crude slate. We've had some additions in the North American market where you've had some pretty complex and some flexible assets expanded to, such as the Motiva, Port Arthur refinery, the Marathon, Garyville, and we've got projects still for BP Whiting and for ConocoPhillips Borger. Now, some of those are complex refineries, but they're also disadvantaged in the fact that they are geared for a heavy crude slate. So the coastal ones, say Port Arthur, is looking at taking heavy Arab crudes. They're not going to be able to take advantage of the swing in the inland cheap shale crudes that we're getting. On the flip side, somebody like a BP at Whiting or a Conoco at Borger are being able to take the very cheap heavy Canadian crude. In Europe, we've seen a number of similar assets being pressured under the market. You've had Wilhelmshaven in Germany shut down. You've got LyondellBasell that shut down the Bayer refinery. You had Milford Haven for sale and shut down. And you've had a lot of the Petroplus assets in play. Of course, some of them have been sold, and we'll cover some of those in just a minute. And then you've had some where Petroplus would like to shut them down, but the government, particularly in France, said, nope, you can't do that. Now, in Latin America, we've got a lot of additions planned, but they're lagging. They seem to be, every quarter we see that the schedule is to stretch another 6 months to a year for some of these new refineries being proposed and getting started in Brazil and in Mexico and Colombia and other countries coming along. Now, Asia has kept their foot on the gas pedal, so to speak. They were really pushing the accelerator earlier, trying to catch up with demand. But what we've seen now going forward is that it looks like the additions are pacing future demand growth. The Middle East, though, is where the big slug of new capacity is going to come on in the near term. You've had projects underway in Saudi Arabia, Kuwait, Oman, the Emirates, Iran. So, that's really what's going to drive some of our changing pivots as we go forward. Now, let's take a look specifically at the regions. This is, again, data from our annual World Refining Outlook just released. If we look at from the left, look at the North American, South American markets, what you've seen in the U.S. is over time periods where we've had some shutdowns and where we've had some new projects come on, such as Motiva's refinery. In Latin America, you've had one shutdown or a couple of small shutdowns, but then you see this really big boom toward the end period 2016-2017, which is all the PMEX, the Petrobras refineries. But again, they're lagging toward the latter end of the 5-year window as we look forward. When we move into the Eurozone, Africa, and the Russian market, you'll see that there's, again, shutdowns now. Europe has one big expansion planned in Turkey, again, toward the middle end of the 5-year windows in 2014-2015. You've got some new capacity in the former Soviet countries and Russia, but there's a lot of upgrading going on of existing Russian assets that will still come to play. Again, a lot of things proposed in Africa, but not many of them coming forward to fruition yet just because of financial support, uncertainty of the government policies, things of that nature. Where all the activity is back to our two booming geographies from a demographics and economic point of view, and that's the Middle East and Asia. You can see, again, we've got in a couple of years is when we're going to see the big expansions come on board, well in excess of their local regional demand. And then you've seen where we've got this slug of capacity in the Asian market, and then finally tailing off toward 2016-2017 time period. So where does this leave us as far as how this impacts our regional pivot areas? Well, let's first look at the Atlantic Basin, because that's really where all the bloodletting has occurred. You look at the refiners, I say we're kind of looking at the abyss. Sun and Philly being planning to be shut down later this year. The Petroplus refineries, Switzerland and Antwerp, have actually been sold. They've kind of been pulled back. And then, of course, ConocoPhillips has just sold their Trainer refiner to Delta. It sounds almost more like a basketball arena, the Delta Center, the Delta Trainer refinery. And even you've now got the Asian national oil companies involved in this region, with PetroChina purchasing Valero's Aruba refinery. You've had in the last 2 or 3 weeks more assets being threatened to be shut down. For example, ERG announced a couple of weeks ago they were looking at turning their Rome refinery into terminal operation. And then just the newest on the block just this weekend, back in the Canadian marketplace, where Imperial says, if we don't find a buyer, we're going to shut down the refinery and turn it into a product terminal. You still got a lot of major assets on both sides of the Atlantic that are facing the abyss, so to speak, to some extent. Petroplus is still trying to sell the Corrigan refinery. I think they had 2 bidders. Now it's down to 1. Of course, Petit Couronne is being kept up because the French government says stay up and running. They want more people to try and find it. The Barra refinery is down, and Lyondell tried to find buyers and just was unsuccessful. And then, of course, you've got the 3 much larger facilities that are on the market that won't shut down, per se, but they're shopping for new owners, which are the 2 big BP assets in Texas City and their Carson, California refinery, and, of course, ConocoPhillips Alliance, or I should say now it's Phillips 66 Alliance. What we've seen in this list of the refineries that have sold is that there are a lot of new non-traditional buyers coming into the marketplace. You know, it's not the majors, super majors, or even the large independents, but it's companies that were kind of in the peripheral of the marketplace that have stepped in to the refining business now. You've had the trading companies that have been recently purchasing assets, such as Vitol with it at Atlas in the European market and Gunvor. Although I should say Vitol has been in the refining sector for a long time. People may not remember, but at one point they owned the North Atlantic Come By Chance refinery, and of course they've been running a refinery in Fujairah for a period of time. Then you've got the private equity players. TPG, Clash are 2 of the major ones that have purchased refineries in both the North American and European market. And then now with PetroChina coming in to buying the Aruba refinery, you've got national oil companies stepping up, acquiring operating assets on this side. Although PetroChina is a 50-50 partner in INEOS in the European market, this would be a direct buy probably a direct operation for them. And then you have the consumers, which is unique. First time we've seen someone in the vertical chain, a consumer, step backward like Delta to get into the refining market. A lot of people have a lot of questions on how the economics of that will work out, so it'll be interesting to see how that plays out over the next year or two. So let's go back and take a look at our map and really say, what has happened with our pivot points. What you have here is, in this case, the bubbles do reflect relative size of volume, but this is showing through 2017 the amount of capacity coming into our major supply regions. So again, very little in the North American market, a pretty good volume coming into the South American market. Then we cross our line, kind of our pivot point line, our line of demarcation, or as my colleague Mark Rout would say, the fault line, across the Atlantic into now the European, African, Russian sphere. There you've got some capacity being planned, and again in the African market, nothing really to speak of in Europe, and the question is still out of what all is going to happen out of Russia. But the real big change is when we look and jump across our line into the third pivot area, which again is the Middle East, Asian market, where you have a lot of capacity coming on in the Middle East countries and even more capacity coming on in the Asian market. Now the demand is there in Asia to keep that production at home, but for the Middle East, they're going to outstrip demand pretty quickly, and they'll be looking for a new home. And that's where, again, these fault lines and pivots are going to come into play, because you're going to see more changing dynamics. So how have our pivots changed? Again, if we think about the old world order, the old days, European-centric, Europe supplied the U.S., Europe supplied Africa, Europe supplied Latin America. Today, we're seeing much more so U.S. is supplying Latin America until their capacity comes on. We've seen the European supply into Africa dwindling over time. We're seeing Asia again every now and then opportunistically coming to the West Coast. But the real change is we're seeing a pickup out of that Middle East market of product moving into Europe, moving into Africa, and of course crude going into Asia. So as I go to, we have another poll question here.
Okay, so the question is, what do you think the oil price will be for Brent by the end of this year? And this is just your educated guess is as good as mine. Is that right, Karl?
Yep. We're just asking for people's opinion on how they view the markets.
We'll open the poll for about 45 seconds. And so what do you think the oil price will be for Brent by the end of this year?
Looks like we're getting a pretty equal distribution on here.
It does. Okay, let's see here. Go ahead and close that. Show the results. Okay.
Okay, so it looks like we're kind of centered, besides the no answer, is that most people look like poll look like it'll be in the price range kind of where we are today, $100, $110 a barrel, and some think it'll drop down to the 90 to 100. I see no one has volunteered the less than $90 one. We did have one person in our earlier presentation today that did say 75 to 90 was a possibility, and one thinks it'll be higher. Okay. So we look at our new world order, and if you remember the initial old world order chart, we had kind of the sphere of influence centered in Europe. Now it's centered into the Middle East and the Western Indian countries. As we look here from the flows, and again, the arrows are just indicative of flows. They're not related to the actual volume. We still are seeing movements to and from now, kind of the vertical, between North and South America, where again we're seeing now not just the Caribbean Atlantic Basin movement, but with some of these new refinery projects in South America, that we're going to see trade flow up into the U.S. West Coast and Pacific side of South America, again with some opportunistic movements from the West Coast to and from Asia. The real action is going to play in the next pivot area, where we see a lot more volume coming out of those new Middle East refineries and the export refineries in India coming into not only Africa and to the European market, but even we're starting to see some signs of movements into the South American market, again, until their refineries come on. China's Asian market's kind of keeping its own demand at home. So, I mean, we are going to see product flows, though, as projects, when the projects come on board in Asia. Until then, we're going to see product flow from these Middle East, Indian export refineries to the Asian market, just like crude today does, where there's kind of a split. They can go either to the east or to the west. We're going to see the same type of thing. So when we look at what's happening with the regional pivots, let's kind of put this in perspective. We're seeing changes underway already. We've seen the U.S., Atlantic, Northwest Europe markets, the supply centers, they're kind of hollowed out. When I say hollowed out, it means we've gutted some of the capacity. Now, some of the refineries are like, as I've seen them quoted as vampire refineries or zombie refineries that keep coming back from the dead. But the truth is, we've lost capacity. It probably is not coming back. And so it's no longer the European-centric refining center. We do see with the Middle East and West India becoming the new supply points that they're going to have the major role going forward over the next 5 or 10 year period as regional trade flows of being the key pivot. Now, Russia is kind of the wild card in this because we know there's a lot of project work underway to improve the existing refining operations and add capacity, but it's not as clear as we see in the Middle East and other markets. When we look at the point about supply points going toward unmet demand in new directions, we see, again, over this long period, Asia is becoming a little better balanced, keeping up with new projects, keeping up with its demand. Latin America is still lagging. If you remember the capacity chart, most of their projects are now moving back to the 2015, 2016, 2017, and maybe 2018 period. Of course, as I mentioned earlier, I can't keep repeating it several times, Russia has got a lot of excess capacity in play and is improving it to put it back into work. One of the interesting factors of besides all of this demand pulling our product flows in different directions is also the price of shipping. People don't remember that back in the mid-2000s, shipping was very expensive. And today, with cheaper freight rates, it's kind of like my arm reach is much longer. I can now move my product much farther distances away at the same shipping price. So it really extends the reach of some of these export centers. And it's going to have a big impact if shipping stays the way it has been going forward. If we look at the Asian market, it's kind of, I call it pivoting upon itself, but it's really staying within China and perhaps India. The question in India, because of the tax treatment of import or the domestic refiners versus the export refiners, is will the government change those rules? And if it does, it could shake things up even more. Because right now, if you're an export refiner, you've got to move to another region. In the Middle East, it's, as we showed in the earlier New World Order chart, it can move either way. It can move into the West, into Africa, Europe market, or if the price is right, it'll go back into the Asian market. And in some cases, the national oil companies are going to make that decision not only on just pure dollars, but also on the socio-economic grounds of, do I have a strategic relationship with one of the other countries as far as supplying them product. Europe, we still see exports coming across the Atlantic Basin into the East Coast, but they're starting to wither. They're starting to slow down. And again, I think as the Russian movements and what Russia's plans come to fruition, that's going to just have a big driving change in what happens in the rest of the European market. On the America side of the Atlantic Basin, we've lost capacity in the Atlantic Basin. The East Coast refineries, a lot of them are shut down. Some are coming back, but still we've lost net capacity. In the Gulf Coast, frankly, for those coastal refineries that I call the heavy hitters, the ones that process the heavy Venezuelan or Mexican or Arab crudes, they are going to stay relatively profitable. And frankly, it's been the Latin America exports that's kept the margins up and kept them in the black over the last few years. Of course, now we do have an election coming up in the U.S. this year, and politics has been playing a part in part of the regional supply picture for crude oil, looking at the whole issue about shale drilling and Keystone Pipeline with Canadian crude. So it's, there's going to be some interesting dynamics as these pivots change directions. So I guess I'd say, kind of, Amy, wrapping up, is that, kind of stay tuned. Is they used to have the old GM car commercial about, this is not your father's Buick. This is not your father's refining industry anymore.
Thank you, Karl. Appreciate that. A lot of useful information. Again, I'd like to remind you that if you have a question, you can type it in the chat window, and I don't see any questions yet. We're also going to take a quick look. One final poll. This is more of a survey. Let me get it pulled up real quick. And this is more for our information. How did you like it? How did you like the topic? Was it valuable? So let me open this poll. Okay, the poll is now open. It's also on the PowerPoint screen, so that the whole question: was the topic valuable? Was the presentation clear? Would you be interested in future webinars? How do you rate the webinar overall? And then we also want to hear if you have any questions or any suggestions on topics. We'd love to hear that, and the email is on there as well. Taking a quick look here, let's see if we have any chat questions. It looks like we do have one.
Okay. One of them here was, actually we had a couple. One was looking at the impact of shale oil on refinery economics. We certainly have seen a big impact of that in the North American market, and I think we're going to see some of that in other regions as they start developing their shale drilling activities. China, I think, is a big one. Certainly in the Americas, it's almost the haves and the have-nots. If you're a coastal refinery running imported crude, your marginal economics, but you're doing okay. Whereas if you're an inland crude refiner that can take advantage of the shale light sweet crude, you're doing very well. Part of that, I think, is going to be, depending on where and the quality of the shale oil found globally, is going to have an impact on refining investment going forward. Because if you're a refiner geared to run the very heavy crudes, you can't run light sweet crude. And that's going to mean, you put all the money at the bottom of the barrel, you're going to spend a lot of money in the future to the top of the barrel. So I think it'll be interesting. See, there was another question asking about looking at CNG. We've just published several of our global energy perspectives looking at LNG and the shale gas markets, and we certainly are seeing compressed natural gas becoming a bigger play in the North American market, and certainly in the Asian, Africa, like for example Australia with all the projects they have going on there for gas. It's interesting. I think the key determination of whether that's going to be successful is infrastructure more than anything else, because you do get vehicles. We're seeing a lot of cities turn their fleets for buses and trucks, et cetera, over to compressed natural gas because there's a central fueling place. But it's going to take time for the rest of the industry to start putting your CNG station down from your gas station. Let's see, I think we had one more question come in, which is talking about how the industry is going to adapt for the change in diesel demand growth while gasoline demand shrinks. Again, I think it's going to go back to investment dollars. Europe was more of a hydrocracking type of refining configuration. The Americas with gasoline were more cracking. And what we're seeing now, at least for major investments in the North American market, are people looking at hydrocracking projects. And certainly we've seen that as we've done feasibility studies in Africa and Asia and South America, where the hydrocracking distillate type of production configuration is preferred going forward. Okay, here is one. How will Canadian oil sands issues impact the U.S. market for upgraded crude? Environmental issues. This is going to be an interesting one. This goes back to politics. I think, as one of my colleagues said, all things will be answered November 7th, the day after the U.S. presidential election. Really, when we look at the environmental issues for those type of heavy crudes, you do have the greenhouse gas concern, but that's really been taking, I think, somewhat of a backseat to the water concerns. That the demand for water use is something we're seeing in our strategic practice, and clients calling and asking about, what are people doing trying to manage water better. We certainly have been working with a couple of equity firms where they have been trying to fund technologies, and it's actually all the projects have been coming out of the Western Canadian marketplace on how do I clean up the bitumen processing. So I think it's going to play a big impact. Let's see here. This one more question here. If price stays at 100, will some of the new projects be canceled? That depends on where the project is located. If it is in a country in the South American market or the Asian market where it's a national oil company, I think it'll get delayed, but I don't think they'll be canceled because there is a socioeconomic, a strategic, and a security of supply question going on there. If it was in the U.S. market, I'd say you might see some things canceled long term because it's more of a free enterprise market. And if one of the major independent refiners can't justify the investment, they're just not going to do it. So I think the answer is it depends on the location. But what we've seen is more often than not, some of the major projects have just been delayed several years rather than just totally canceled. I mean, even the big Kuwait refinery that everybody thought was gone 3 or 4 years ago is now back. They're out there getting contracts for engineering. I think that was our last question. Sandy,
Okay.
I'll turn it over to you.
Okay. Again, we thank you for attending our first Insights on Energy webinar. Future webinars will cover market conditions, asset optimization, investment support, and sustainable workforce development. And again, we welcome your suggestions for topics that you would like to see. And actually, I have one more closing slide. Information on our next webinar that will be held in a few weeks will be sent out shortly. We'll be sending out information on that shortly. So again, we really appreciate your participation and have a good day.